let's admit it, there are a lot of myths out there about infinite banking, what it actually is, how you use it. In this video, good news for you, we're actually going to talk about how you can use it, how it really works, how do those loan things work after all, and compounding interest and all that stuff. And really, how is the wealth wheel that we teach uniquely in this process, how do you use that to actually build your money faster so that you can invest more and make money in two places at the same time? So let's just get into it. All right, so first and foremost, what is infinite banking? Like, how does it really work, right? Now, there are a lot of different theories out there. A lot of people teach you that it's always just this thing you put into retirement for someday, right? Like, you save into this thing for decades, and then finally you can pull out some tax-free money. That's true, but there are so much sexier ways to use it than that. So, I'm gonna talk about this first and foremost, is that I like to use it as a way to make money twice. What that means is this, is that I can borrow from this money. I can use the money. I can take out loans from these policies. But here's the good news about these loans. There are no minimum monthly payments. They do charge interest. However, at the same time as you're being charged interest, you are also earning interest on that money. And you might think, wait, how am I making money on this? Easy. Here's what most people do. When they invest money, right? They are typically using this money to just pull out a savings and then throw it into an investment. You make money in one place, which is that investment, right? But here's the problem, is that, think about it. If you had this ideal world, wouldn't it be awesome if you could have a savings account where you could pull the money out of it, invest with it, but the money never disappears? So you're still earning money and interest in the savings account, and you're earning money in the investment. Wouldn't that be the ideal savings account? That's exactly what you can do with infinite banking, is because you don't actually pull the money out, although you could do that. But the thing is, all of us investors know, if you do that, we lose the ability to earn interest on it other than the one place it goes to. But again, if you think more like a bank, right? You think more like what an investor likes, which is, I want to make my money make as much as possible. What I do instead is I get a loan from the insurance company where that money is collateral. They know the money's going to be there. They know it's guaranteed because it makes at least 3 or 4% a year guaranteed. That's way higher than the guarantee you're going to get from your bank. And on top of that, for the most part right now, they're earning at least 5 or 6% right now. And that's going up all the time because interest rates have been going up. So when you see those higher interest rates, you think, yes, I make more money, right? So that's the good news. So you're getting paid between 5 and 6% tax-free on that money. And guess what? You do pay interest to the insurance company. Don't ever think for one moment, don't let anybody lie to you that you pay yourself back, like many of them will teach. Even here on YouTube, you'll see those videos. That's not the case, because you do pay them back interest. But remember, they're charging you a pretty darn low interest rate while you're also earning roughly about the same interest rate. And here's the key. Here's what makes it work. If you can use the money to pay it back to keep the interest being paid, say for example you're investing in something that has cash flow, like a real estate property that has a cash flowing component to it, that money comes in to pay down your loan, much like you're paying down a home equity line of credit. You do that, you get charged less and less in interest, while at the same time your money over here is growing and compounding more and more in interest. And this is a key concept that many people don't understand, that if you understand it, it's like mind-blowing, right? Because here's what happens. You're compounding interest over here. Remember, your money keeps growing and compounding. Think about, like, even a simple example. You have $100,000 making 5%. The next year you have $105,000. But the next year, if you make 5%, it's not $110,000. You don't grow by 5,000. You grow by 5,000 and a little bit more, don't you? Because you're making 5% on 105,000. So now you have 110,000 and change after year 2. That's like 115,000 and change, and that's like 121,000. It just kind of grows and compounds. But on the flip side, when you're paying back these loans using the cash flow you're earning from your business ideas, from things like real estate or other investments and things that you might be doing, that money is then paying down the loan, or at least paying interest only, so that it does not compound against you. That's called simple interest. You have simple interest that you're paying, but you're earning compounding interest, and they're not the same. That's why sometimes I'm actually okay when I get loans, like I recently got a 3.9% car loan that I'm totally cool with, because I know that I could take that same money from that car loan, I could put it into a 5-year CD, and guess what? I can actually make roughly about double the interest rate in that CD, even though I'm only earning just about the same interest rate as what they're charging me. That's the power of compounding interest versus paying on simple interest. So that is exactly how people are able to make money in two places at once, because you're making this net profit from the compounding interest versus the interest you're paying them, and you're making money over here with the investments that you're making. And this is kind of what I refer to as the wealth wheel, right? Is that the wealth wheel is simply this, is that you get a policy that you set up. Now, when you set up these policies, do not dump in tons of cash into these policies. This is a big warning. This is not something you just dump in one time. Although that's an option you can definitely do, the problem is this. The person that makes the most money is not you when you use that method. It's the insurance agent. They love it when you dump in money. And there's people even here on YouTube telling you, hey, you should throw in a bunch of money in year one and then pay very little thereafter. Why? Because the agents earn the most commissions in, you got it, year one. That's why they tell you put all the money in up there, because they make the biggest commissions at that point. Do not fall for that trap. That is a lie. That is a ripoff. In fact, let me give you a little bonus here. When you're looking at these policies, right? Especially if you have an agent that's trying to sell you on these policies, here's what to look out for. Number one, if they've got a lot of fees up front, which a lot of them do, don't do it. And what does that look like? It looks like the very first policy that I bought from an insurance agent. See, back in the day, I was a financial advisor. I knew about different types of insurance, but I really didn't know anything about whole life other than I thought they sucked, right? I thought they paid you no money. I thought they were a waste of money. Don't do it. But after I got into the real estate investing world, and all these real estate investors are raving about this infinite banking concept, I thought, you know what, maybe I should try it out. And so I went to an insurance agent. I went to him and I said, hey, you're the expert at this. How do I design it? And then he spits out and shows me the numbers. He says, hey, you pay $1,000 a month into this thing forever, and look what happens. Eventually, down the road, you'll have a bunch of cash. Now, being a financial advisor and having dealt with other types of insurances before, like universal life insurance or term insurance or even just variable universal life and things like that, I thought, you know what? Is there a way to make this better where I have more cash that pays me a better return up front? You know what the insurance agent said? He said, no, you can't do that. In fact, if you try to do that, it'll trigger taxes and you don't want that. And of course, not totally knowing all the ins and outs, I said, I'll take your word for it. Maybe like what you would do, right? Like you'd probably just say, you know what? You're the expert, you're the insurance agent, I'll just take your word for it. I did the same thing. This was in 2006. You know what happened by 2008? That's right, the freaking recession hit us, right? We had the big recession that happened, and as a result, I went from millionaire to upside down millionaire. I had a new business I started that wasn't doing well at that point. My real estate wasn't doing great either. So I was cash strapped. I could not keep paying $1,000 a month into that policy. Even though I was in my third year, it had a couple $100. I had paid 25 grand into it to have nothing to show for it. That was a huge ripoff for me. And so I was mad, I was upset, but I figured there's nothing I could have done because that's just the way it is. That's life. I found out later he could have actually manipulated the numbers to give me a better return on my money, to have money actually not in 3 years, but money from day one. And he didn't do it. After having a 2-hour argument with him, guess what I found out? The only reason he could come up with, eventually, after I knocked down all the fake reasons he gave me, he says, Chris, I did it that way because I couldn't afford to cut my commissions. I said, there's the truth. And by the way, I'll never do business with you again. Just so you know, he's out of the business now. He now works for a bank. Watch out for those bankers. So anyways, so this is the thing, guys. Like, if you have a policy that you see that the first few years you don't have hardly any cash in it at all, bad. If you actually put money in, I would like to see at least 75 to 80% of the money I put in year one, they're in cash. That's mine and I can access. So for example, if I put in $10,000 a year, I would like to see at least $7,000 or $8,000 in there. In fact, we actually had a guy that's a big YouTuber that he was doing a policy for someone who was a friend of mine for his brother. And he was so excited. He's like, man, I'm putting in $10,000 a year and I got $7,000 day one. And I knew this guy was young and in good health. And I said, guess what? It should be $8,000. You're overpaying by $1,000 a year that you're wasting for no good reason at all, other than they're just making more money. Actually did the policy on him instead, exactly the way we explained it. He had $8,000 that first year versus $7,000. Guys, that's the big thing. By the way, if you're ever curious about yourself, feel free to reach out to us and ask us. We actually, moneyripples.com, you can actually book a call to see what it really looks like in your situation or if it even makes sense. So anyways, that's a little pro tip for you. Going back to that wealth wheel, right? Now this is what we want to have happen. The cash is coming in, right? You got the cash coming in, you put it into the policy. This becomes your new savings account. That's what you use to invest in your business or in real estate, whatever it might be. And then as you get the loan out, right? You get the loan from the insurance company, not from yourself. You're not just withdrawing the money, so you lose that interest. You get the loan from the insurance company. Use that to invest. And then the cash flow from that investment goes back in to pay down that loan so that you don't compound against you. You actually get it to the point where it's simple interest while you're earning compounding interest. And that works faster. I actually showed somebody recently where they were actually wanting to put in roughly about $25,000 a year into this. And they're also doing other investments as well. Now, I told them not just dump $250,000 into a policy. I said instead, let's invest $200,000 or so of that while only doing about $25,000 a year. Here's the cool thing. If you have, say, $200,000 that you're investing earning 10%, you're making $20,000 a year. If your premium, that the max that you can put in, not even the minimum, but the max you're trying to put into these policies is 25 grand, guess what? The investment's already paying for the policy, plus whatever money you're already saving anyways. So you're in a much safer position versus just throwing all your money in and then hoping that you can pull some money out later. No, you can get your money invested today and get that money working for you tomorrow as well. And so doing that same kind of strategy actually shaved off, they were trying to hit their passive income goal of $10,000 a month. Well, if they just used their savings account, they would have taken about 11 years to hit it. But with using this infinite banking type policy, what we refer to as max ROI infinite banking, because you want to get the best ROI you can out of it, instead of taking 11 years to get there, they were able to do it in 10 years. That shaved off an entire year doing nothing different other than just where they stored their savings. Instead of keeping it in the bank, they kept it here in their own infinite bank. That is how you actually get your money to pay you in two places at the same time and throw a little extra fuel in the fire. It doesn't get you financially free, but man, it can get you there just a little bit faster. That extra year of his life that he's saving, there's a lot you can do in a year. There's a lot of life you can live. What if you knew you wouldn't live more than 15 years? That extra year can mean everything for you and your family just to make sure that you have as much life as possible and freedom as you can get right now. So here's what I'm going to ask you to do right now. Like again, if you want to see how this actually works and you want it pressure free, just go to moneyripples.com, book a call right there under the infinite banking section. You can find out how this looks for you to see if it makes sense. And by the way, if you're already looking at other options, hey, let us throw our hat in the ring. I can guarantee we will beat anybody else out there. That is our guarantee. And we'll actually give you the numbers. None of this little crap, about trying to hide numbers. So go reach out to us at moneyripples.com right now.